Hello, this is Abhilash Jakumar, co-founder and co-CEO of TresVista. Welcome to TresVista Talk. Today, I'm joined by my friend Brett Hickey of Star Mountain Capital. Brett, thank you so much for joining me. So Brett, you're my first repeat guest on TresVista Talk. You were one of my first guests when I started this podcast early in 2020, not knowing that we'd be in a extended work from home situation at that time. And it's been over 4 years since that first conversation. The world has changed a lot in 4 years. When we had that first conversation, we thought, oh, markets will be rough for the rest of 2020 and maybe into 2021, and maybe we'll see a recovery in 21. What we didn't think is that markets would rip right after the first couple months, like get to unheard of heights and then stall out and then come back and freeze. And it seems after a long period of sustained growth, uncertainty is just all over the place, right? How maybe can you share with us how you navigated the last 4 years and maybe what lessons you've learned that are going to last for you?
It's a great question, Abby. And I always feel that market environments are uncertain. Whether if you think things are going really well, chances are that's a good time to take a step back because there may be challenges that are less obvious. I would admit that I've been wrong for quite a few years now, thinking that we're overdue for a downturn. But ultimately, the U.S. consumer in particular has been quite resilient. Now, the big X factor there was the amount of government stimulus that ultimately really buoyed the entire economy and the U.S. consumer that continues to spend and drive the economy. But that's no longer happening. Demographics are aging, and companies' EBITDA revenues and so forth are softening, and we have declining populations coming in the two largest economies in the world, the U.S. and China. So there are major, I think, forces at play. You overlay that with the amount of leverage that different governments have, that you can't keep levering up forever. The U.S. government obviously has been able to produce capital, invest capital into the economy, and that drives enormous global stimulus, given that the U.S. is the largest economy in the world and in a very consumer-driven environment. So when we think about lessons, when I started my investing career in the late 90s, and I think about an '01 environment, an '08 environment, and pandemic environment, key fundamentals that we adhere to at Star Mountain are really the basic values that we all know, but it's sometimes surprising how people operate. One is alignment of interest. As Warren Buffett and folks would say, tell me how people are economically aligned, and I will tell you how they'll behave. If we look at the pandemic, alignment of interest was critical. You mentioned working from home. At Star Mountain, we're a 100% employee-owned firm. 100% of our U.S. employees share in the carried interest and profits of our investing, and therefore care about investments and clients performing well because it directly impacts them. Whether or not somebody's watching over your shoulder or observing what you're doing or not, which during the pandemic, it was hard to observe what people were doing. So it was interesting. Because of our secondaries business, we're invested in about 70 other funds, and just having been now in the alternative industry for about 25 years, there's a lot of friends and you talk to them and what's going on, what's happening with employees, what are they doing? And we actually found at Star Mountain that we had a really focused, dedicated, disciplined, and driven team, which I'm, of course, very thankful for. And ultimately, they drove value and they were focused on protecting value because it directly impacted them and the rest of their team and our firm and our investors. And so alignment of interest, as simple as that sounds, it's interesting. Bloomberg recently had an article in Private Credit saying that they estimated that about 40% of managers have no economic alignment of interest. What I think that underestimates are there poor economic alignments. Never mind just not being economically aligned. Are people aligned to take extra risk, such as getting a loan closed because they get a bonus, irrespective if that loan performs or not. So the other thing we do in alignment is all of our senior investment team has substantial personal capital invested. They sound like basic premises, but I think it helps drive behavior that mattered a lot during COVID. It mattered a lot heading into '01. It mattered a lot heading into '08. It mattered a lot during '08. Going through challenges. If we have an economic downturn, challenges are very likely. During COVID, there were a lot of challenges, especially for how we invest. I mean, frankly, it was probably one of the biggest stress tests we could do at Star Mountain. We're very focused on investing in different service-oriented businesses in America. And other than certain essential services, many businesses were shut down. So companies that were otherwise very recession resilient, whether it's a special needs school bus transportation, kids all of a sudden aren't going to school. That wasn't the case in 2008. That wasn't the case in 2001. To my knowledge, that wasn't the case in any other type of recession. So there were a lot of businesses that in how Star Mountain invests that are usually recession resilient. COVID really hit it. And so we certainly had to roll up our sleeves and get very operationally involved. And I think that's one of the other items about investing that's really important, Avi, is that you have people that are economically aligned and experienced. One of the other dynamics that we've faced in just the economy is that we haven't really had an economic downturn because COVID was government stimulated in a way that didn't have the same type of outcome that a normal downturn would have. And so if you graduated college at or after 2010, you haven't really experienced any type of economic downturn. So we have now an aspect of 14 or 15 years of people working, some of which are, great, highly talented professionals, but haven't gone through those experiences.
Yeah.
And as a CEO, Avi, and working with a lot of people, that unfortunately in life, some things are learned by experience. There's apprenticeship style learning. Well, for apprenticeship style learning, you have to be in the market, and you still have to be working, versus in school and kind of reading about it. And I think that is perhaps created an environment where people underestimate how hard challenges are to work through and the resources you might need. People have built for this potential downturn, and I guess I've probably been wasting money in one hand, building up resources because we haven't had a real downturn for a while. But ultimately, I think that that's important, and that's an aspect of that gets into back to team alignment, values, and so forth.
You first talked about motivation being essential to not have underperformance, and then you talked about experience. And I think you said it nicely using the word experience. I was going to use the word competence, right? Experience builds competence. And, for people listening to a podcast, I can't see how amazing your hair looks, but you don't have gray hairs. But you started your career going through the tech bubble bursting, and then you started Star Mountain right at the tail end of the financial crisis, right? So you've had that experience of downturns. And if we look historically, downturns happen every 5 years on average, right? I can't think of a time, forget me being alive, like post World War II, of a 15-year stretch of good times, right? And basically since the financial crisis, money's been free, right? And governments have bought good markets for us. And so you're right. There's a lot of people who've never experienced that, but those people are now in positions of leaderships in organizations across the world. So, you and I got our chops in the worst of it. I started my career as a tech banker in the tech bubble, right? And similarly started TresVista 9 months before Lehman Brothers collapsed. And you learn a lot in those times. And sometimes people might think you're crazy when you're preparing for a storm and it doesn't rain for years and years. But obviously, when it does, you're going to be in a much better position of strength. But how do you feel your business is impacted by an ecosystem of businesses, management, professionals, leaders who are unprepared for uncertainty? And what opportunities does that create for folks like you and myself who are always thinking about when the shoe is going to drop?
So you talked about the expansion that's been really almost a 15-year expansionary period, which is extraordinarily long and far longer than normal. The other thing that people sometimes talk about is ADD, technology, all these kind of things where, everybody has attention challenges of a whole bunch of things are coming at you, irrespective of who deals with them better or worse. And so we live in an environment where a lot of people are hyper distracted. And the concept of focus. So you talked about competency. We also think about you have a competency, but then are you aligned and focused? So for example, there's a lot of people, I'm sure you know them, friends that are, investing in a whole bunch of miscellaneous things that have nothing to do with their career, spending time on a whole bunch of things that have nothing to do with their careers, nothing to do with their investors. And, I kind of wonder, what does that do? How focused are people? Are they thinking about risks that might come, or are they mentally distracted in too many other things? And so focus is a big thing to us at Star Mountain. And I think that it's a cousin of alignment, if you will. The uh, preparation for a downturn, I think, to your point there, is, I think, undervalued. And, happy to dive in deeper, but I think in general, it's hard to invest into challenges for some folks when challenges aren't there. In my case at Star Mountain, similar to you, I have 90% plus of my net worth invested in our business. So I wake up every day highly focused, thinking of it, thinking about tail risks. And when I started my career on the investment banking side within the financial institutions group, working with a lot of insurance companies, you think about probability management, you think about tail risk management. And I think that that's a really important thing, because at some juncture, a focus is avoiding tail risks. And certainly that's a lot what we think about at Star Mountain. How do you avoid tail risks and how you're building, running your business? And given the economic environment where we'll probably have rates that come down, that will likely mean we're continuing to have economic pressure. And we assume that payroll will continue to decrease, and layoffs will continue to increase. And eventually, the stock market probably comes down. I was on with a research expert yesterday, in fact, talking through his model assumptions, and basically thinks there's 20-25% overvalued in the stock market, for example, on average. And I'm not here to pick stocks or make predictions on stock markets, but I think we can all agree that they're certainly not at lows, right? They're floating around and keep pushing through all-time highs. And if you look at how many all-time highs have been crossed in the last few years, it's a lot of all-time highs. And if you look back to major market recessions, such as back in 2001, and you look at the valuations and you kind of just look at a roller coaster, downturns don't seem to come when the stock market's going down and is challenged and then has a big drop. It seems to be you're in a roller coaster and you're at the top and it's got momentum, and then it drops because there's just such momentum that can build, and some valuations get so high that even if you strip off some of their value, they can still be perceived to be overvalued. And many psychologists would say people are either driven from fear or greed. And if you're in a bullish sentiment, then you're bullish. And if you switch into a bearish sentiment, then people stop spending, stock prices drop, then earnings do come back down. And that's our assumption, is that will in fact happen. And I'm not a public market investor, and I've been wrong for many years. So maybe that means you should go buy a whole bunch of stocks right now, but that's not what I'm doing.
One thing that's also changed over the last 15 years is the world is just so much more interconnected now, right? Obviously, I'm sitting here in Bombay talking to you in New York. This wouldn't have been a thing 20 years ago. And it seems that shocks in one part of the world that seem seemingly disconnected somehow find their way to trickle through and impact local businesses. How does this global ecosystem now factor into how you think about investment risk?
One of the reasons I started investing in the lower middle market exclusively 20 years ago is because of the view that you can find businesses that have less correlation to what's going on in a world that is more and more correlated. For example, a special needs school bus transportation company. If you ask yourself, how in an economic downturn does that impact? And if you look today at the markets over the last 20 years in the US, the number of publicly traded companies has been cut in half. If you look at most private or most businesses in America, over 90% of them are private businesses. So when you look at the stock market, and some people may think they're diversified, there are fewer and fewer companies in that stock market every year, and the percentage weighted into the Magnificent Seven and others is extreme. And so the amount of correlation I think investors have in their portfolio globally in different mutual funds, ETFs, you name it, things that people often think of as, oh, I'm in something very diversified, an S&P 500. Well, you may be more concentrated than you realize. And to your point, that also creates economic correlation because of how many people that don't realize how concentrated their portfolios are. And so I think that some of the smartest investors right now are saying, look, predicting what's going to happen in the economy is very difficult, but we know it's concentrated, and we want to find good investments that are less correlated to one another. And that is harder and harder to find. It's one of the reasons that, again, we like the private lower middle market. When the economy was booming, people weren't riding the school bus more. But when if the economy drops, people will presumably ride the school bus roughly the same amount. Now, that doesn't mean there aren't risks. There are idiosyncratic risks. You still have people and so forth, which is why at Star Mountain, which I believe now, Avi, since we spoke last, I think we're now the largest team that's dedicated to the lower middle market in the United States, with over 100 full-time people and 40 operating partners. And we take a very active portfolio management approach to help mitigate some of the idiosyncratic risks around the businesses.
You just said you have 100 people doing lower middle market investing. That, whether it's private credit or private equity, that's probably one of the largest firms in the lower market. But what always struck me about you is, more than being an investor, you've been an entrepreneur and business builder. And to a certain extent, anyone who starts a fund is an entrepreneur. But most people who start a fund don't necessarily have an ambition, or very specifically don't want to build a business. They don't want a large organization. They want to make good investments, get great returns, get their carry, and do it again until they want to stop doing it. How has building a business actually helped you make better investments?
It's a great question. One is understanding the realism of challenges of managing people, hiring people, retaining people, taking your business to the next level. What you did to get to 20 million of revenue might be very different than how you need to operate to get to 50 million of revenue, and so on and so forth. And so I think going through that journey builds an appreciation, understanding. I think second, in my case, having been a founder now for over 20 years, I've been part of different, and fortunate to be part of different CEO type of organizations, like We're In Together. I've been in YPO for, I believe, 18 years now. I was in EO, Entrepreneurs Organization, prior to that, so dating back almost 20 years. I joined the CEO organization not long ago. So a big part of my ecosystem and network are founders and senior executives of companies. And by talking to them, where you're sharing challenges, opportunities with each other, I think you really gain an appreciation for the realism of running businesses, thinking about people risk in companies we invest in, and how you monitor, how are the executives doing? Are they healthy? Are they on the ball mentally, physically? What's going on? McKinsey Consulting came out with a book that I believe they correlated about 60% of the performance of a company to the CEO. So how do we make sure that our businesses have great CEOs, not just ones that built it for 20 or 30 years, but ones that are going to build it for the next 5 or 10 years? So I think the gains in appreciation around the realities of investing, the realities of working through challenges. When you think about a challenge, like, oh yeah, here's my mob, like lay off a whole bunch of people, this is great. Well, how do you keep your staff energized? And when you think about also making great investments, we're in the people business and the talent business is the way I think of it at the end of the day. And so making sure that there's a focus on finding, developing, coaching, managing, motivating, aligning the best talent out there is critical to finding, underwriting, and managing the best investment opportunities. So by taking a business owner mentality as a CEO, I think that makes a better investment firm. And if you look at any type of a description of a CEO, most often it doesn't say you should be the CEO and the chief investment officer and you should be doing deals all the time. But many CEOs of smaller firms in the lower middle market, and I had to as well, that's how you have to start your business by necessity. But at some juncture, hopefully, you really take the role of a CEO seriously. Strategy, talent, clients, vision, culture. And I think that all large firms, of course, generally think that way and have professional boards that help build them, but not a lot of smaller private investment firms do. And I think that has helped us.
I often tell entrepreneurs early in their journey, imagine what your business would look like if you had unlimited resources. And nobody has unlimited resources, so you have to make compromises, eyes wide open. Maybe you do wear 6 hats at the same time. But I say write it down up front, because the risk is when you wear all those hats, you forget what your intention was when you started. It was never to be all things at all times, right? And then you think it's necessary. You think, if I don't do all these things, how do I, how will it function, right? So the perception of risk keeps changing as you build an organization. So when you start, it's rough, and you get to a certain stage and things are going well. Do you let go of control? You, in some parts, know you need to if you need to keep going further, but there's risk associated with that, right? And like you mentioned earlier, getting to 20 million is one game, getting from 20 to 50 is another, and going beyond that is another one. Now you've gone through different stages of business, right, along the way. How do you at each stage mentally prepare yourself to accept more risk so that you can get to the next level?
It's an interesting question. I'll maybe reframe it. I don't believe that I accept more risk, but I do think that I have to reframe and look at the business. For example, I tell business owners, and when we look at investing, you're growing or you're shrinking. Rarely are you just moving along sideways, bumping along. Because if you're bumping along, what does that mean your team is doing? Are they excited and motivated and invigorated and creative and focused and all the things you want to drive top quality results? Or are they looking for other jobs? Are they complacent and saying, well, fine, I'll spend more time doing whatever hobbies I want to do and, collect a paycheck. And so we obviously know which type of talent and culture drives value, and it's an invigorated culture. An invigorated culture wants to see career growth. It's very hard to have career growth without being in a growing firm. So I think that is important. Now, I don't believe that actually increases risk. I think it decreases risk over time, because you start to have bigger divisions of people. You start to have more layers of capabilities within each operating vertical. And so I think that as we've grown, I sleep much better at night today than I did 10 years ago, when you're worried about every little thing because you've got I don't know how many people I had then, 20 or something like that. Every person was extremely consequential, and everybody at Star Mountain is incredibly valuable, but ultimately things happen, and you need to build a business mitigating idiosyncratic risk as much as possible. So I think that with size, you can mitigate idiosyncratic risk if you keep the core values, alignment, and so forth in check. The other thing that I do that I think helps a lot is try to surround myself by highly proven functional senior advisors that have personal capital invested with us, that share in the carried interest, that are aligned and motivated and want to help. Former CEOs of asset management firms and so forth that I'm asking questions, divisional heads, former heads of executive recruiting firms, and having different groups of people that are really deep experts in all the functions of where I want to go. We have that, and then we continually reevaluate what's going on in the market. What are smarter things to do, less smart things to do? As we've been thinking about the economy being risky for a while, for example, we'd like to be first lien senior secured loans, controlling our loans. So there's a challenge, we can do something about it. Having good legal documentation and protective financial covenants on our loans. Once again, we can do something, or at least try to do something about a potential challenge, not just be, along for the ride with the strategy of hope, because I think most of us would agree that hope's not typically a good strategy. But you do see a lot of investing out there that is what I'll call a hope-driven investment strategy. And so I think that we all need to be looking at what's going on in the world at all times, and is our business model still the right business model, how we're operating. For example, I'll give you one other item. In addition to partnering, with you guys, Abby, to be able to have light of the day work where we can process information and data 24/7 to make sure that we can evaluate investments the best way possible, so that we can get the best opportunities, evaluate the best opportunities, and actively work with them as quickly as possible to make the best decisions. We also thought that it was smart to open up an office in Tampa Bay, Florida, because of talent retention. New York City is very expensive. It continues to seem to get more and more expensive. And I remember when I moved to New York in 2002, I thought it was expensive then. I guess in hindsight, it was cheap. So I'm glad I'm not a real estate investor that needs to bet on things. But ultimately, we felt that Tampa offered a higher quality environment for people to live in alignment with our culture, including people with young families, where you don't have long commutes to and from the office. If you need to jump home, if a mother needs to run home and see their kid, a father, whatever it may be, you can do that, and you're not in a constant tug of war between family and work, because we want people to be able to have families and work functionally, and not have the negative stress of all of that, because your personal life affects your professional life and vice versa. It is all integrated. And so those are decisions that we try to look into the future and say, what type of long-term investments could we make? And for us, being a private company, we don't have to worry about our stock price every quarter, and we can make long-term investments. We don't have to worry about different outside shareholders. We can make the long-term investments that are ultimately focused on creating high-quality career opportunities, being a talent-centric firm, which we believe is in alignment to drive ultimately returns and value for our investors at the end of the day, which is what I remind my team. We don't work for me. We all work for our investors at the end of the day. And so our business has to constantly be saying, what can we do to drive better value for our investors, and wake up every day thinking about that.
Yeah, I think thinking long term is an easy phrase to say. It's a hard thing to do, and to do collectively as a team. I always say the present value formula is a simple formula: future value of cash flows divided by 1 plus the risk raised at the time. But when most individuals think about how do I maximize my present value, they focus on the future value of cash flow. And which cash flow? The one next year or the 1 year after, because it's tangible. It's easier to wrap your head around, right? Risk is, also somewhat hard for people to understand, but maybe a little easier. They can understand infinite risk, and they can understand no risk. But most of the world is somewhere in between. But where I think people really miss the opportunity to create arbitrage is time. Right? If you're willing to take your payout a little bit later, right? You can do that with a little bit more risk, but not that such that it offsets the value you're going to create for yourself.
Yeah, I think there's time, and two things that really resonate a lot, Avi, from what you just said. One is the world is rarely binary, where it's 100% or 0% probable. Ultimately, what you want is the highest degree of probability possible of your desired outcome, and the lowest probability possible of your undesired outcome. So it's even how we invest. We talk to our team and investors about total return focused strategies. And when we build our portfolios, we say naturally some companies will outperform expectations, some will do as expected, and some will do worse. That, we believe, is the reality. Therefore, how do we design the investment securities? How do we design our team? How do we manage those assets so that when those three types of occurrences happen in a diversified way, how do you create the highest probability possible of the tightest band of expected returns that you want?
Yeah. So if we're sitting here, Brett, 4 or 5 years from now, what do you think we're going to be talking about?
Good question. Well, hopefully we both will be. That'll be a lot of fun. I think we'll be talking about how technology has continued to have major impacts on our business. For example, the AI that we now use at Star Mountain Capital actually was in our war room yesterday. So we have an entire internal tech business strategy team. It was pretty exciting seeing some of the things that we're doing now. Now, it takes a lot of time, money, and resources to make it functional, for sake of clarity. So this quick flip of the switch is if you can just like plug into like cloud computing and it automatically works, which cloud computing was an incredible innovation for data, ultimately what we could do with it, and pretty quick to implement. AI is more difficult. You know, you've got to build, train, match, systematize, and so forth, just like any database in a sense. But I tell you, I'm pretty excited in how it is transforming what we're doing. I think the second thing that we will probably observe looking into the future is we will see more consolidation in the market. I think you'll see fewer generic managers. There'll be more large managers that are serving market data in a cost-effective, high-quality customer service way for investors. And then you'll have alpha specialists, I think, like Star Mountain Capital, that have a very specialized way of investing that has a lot of barriers to entry and is a good complement to an investor's portfolio. And I think you'll see fewer players sort of that are in the middle of somewhere, and you got to pick what you're going to be in life. And I think some people don't. So that's an estimate I think that we'll all see. And my guess is we will have seen a recession between now and then, and we'll have worked through challenges. And for those of us that are ready and prepared for that, often challenges bring opportunities. But I assume there'll be other people that are kind of look back and say, wow, some of that stuff that I was investing in didn't really make any sense. But you know, they invested in it because it was quote unquote working, or a whole bunch of other people were doing it in a herd mentality. And I like, again, Buffett saying of observe the herd, but don't necessarily follow the herd. As far as looking at somebody that's been stocking up a lot of cash, his balance sheet, as far as, you know, Berkshire's doing, having recently just for a brief moment surpassed a $1 trillion market cap. So those are some of the things I think we'll be talking about. And I think we'll continue to be talking about talent, Abby, how we're all building talent and managing to the, you know, next level of what we're both doing with our businesses. I think you've built a great business, and I would guess that you'll continue to build an even better business. And I think that'll be similar for Star Mountain.
Wonderful. Well, Brett, thank you so much for taking the time to speak with me today. It was such a pleasure, and I'll look forward to continuing our dialogue in the years to come.
Abby, appreciate it as well. And thanks to all the TresVista team.